I'm Roger Montgomery from Montgomery Investment Management. If you'd asked me 10 or 15 years ago to lend to small and medium-sized Australian corporates, I would have said, you're crazy. The only small and medium-sized corporates we'd be lending to back then were those that the big banks had rejected and didn't want to lend to. It would have been a seriously risky proposition. But after the global financial crisis and the Hayne Royal Commission, related regulatory changes have made it extremely onerous and less profitable for the big banks to lend to these corporates. And so, understandably, they've pulled back. The result is a $200 to $400 billion gap between what small and medium-sized corporates in Australia need to borrow for growth and what lending is available to them. So today, you can lend to the same quality borrowers only the banks might have previously had access to, and the returns thus far have been excellent. For example, over the last 7 years to the 31st of July 2024, the Aura Private Credit Income Fund has returned 9.64% per year net of fees and assuming reinvestment of income. What's impressive is this has been done with no loss to investor capital, and there's not been any negative months. And that's what funds like the Aura Private Credit Fund do. They lend much needed capital to quality businesses. Today I'm joined by Brett Craig from our partner Aura Credit Holdings to dispel some of the myths associated with private credit. Brett, thanks for joining us.
Thanks for having me.
So I have to confess, when I looked at the returns that you were producing, when I first did that, I saw monthly cash income for back then it was 5 years, it's now about 7 years. You never missed a month. Every month was positive. The annual return was about 9.6% or thereabouts. So it was an extremely attractive return, producing monthly cash income with never a negative month. Mm-hmm. And I must admit, I thought it was too good to be true. There must be risks. How do you mitigate those risks? And I know that there are three different ways that you do it, or three overarching headings for that process.
Yeah, so firstly, we look at the underlying businesses who are borrowing the cash from the lenders that we provide capital to. So what we want is a high quality set of businesses borrowing the money. We look at various methods to assess them.
So at the deal level, what you're saying is at the deal level, you're only looking at high quality borrowers.
Yes.
Okay, so you're not looking for turnarounds or distressed businesses at all?
No,
okay.
No distressed debt.
Sorry, I interrupted you.
Yeah, so no distressed debt there. What we're looking at is businesses that have a strong track record in repaying debt. So we'll look at things such as Equifax scores or creditor watch scores, which really focus on any negative credit impacts. So whether they have missed bills, missed loan repayments, etc. And
you're filtering out those ones that have a lower credit score.
That's correct. And then we're looking at a balance sheet analysis. So looking at businesses that have, lower debt levels in them, the ability to service their loans as well. So that's sort of the quality inputs at the front end of a transaction.
So that's the deal level, if you like.
Deal level.
Yeah.
Then we're looking at the collateral that's actually backing that loan. So if the borrower does fall on hard times and is unable to make their repayments in the ordinary course, in the contractual terms, we will lean on collateral and look to take charge of that and sell down that collateral. So that's the second risk mitigant that we have.
And what are some of the examples of collateral that are provided?
They're broad. So we'll be looking at anything from land, livestock, invoices, pieces of machinery, so asset finance, etc. So
directors' guarantees?
Directors' guarantees, general security agreements, so fixed and floating charges over the business. So you're starting with a quality borrower coming in, looking at the collateral they have backing that loan. And then the third element that we look at protecting capital with is at a warehouse level. So the lenders that we're providing the warehouse financing to are putting their own equity at risk in a first loss piece below us. So you've got the borrowers from a cash flow perspective paying through. If they're unable to pay there, you've got the collateral to lean on. And then you've got the lenders who are putting their own equity and or fees and net interest margin at risk.
So what you're saying is they're all quality borrowers, but if a borrower happens to default and then you collect on the collateral but lose, there's not enough collateral there to support the loan, for example, for whatever reason. So it goes from a default to a loss. Then protecting the investor is the originator or the lender who's also put their capital, their equity at risk.
Yes.
And so what's been the experience in the past?
To date, I mean, we've been running this strategy for over 7 years now. We have not had any losses that have impacted our interest or principal as an investor.
For the investors.
Correct.
That's terrific. The second myth that I want to dispel is around liquidity. There are some ways to mitigate liquidity risks. And I note, for example, your funds don't have any lockups, which competing funds do. And they also have shorter terms. The loan book itself has a shorter term. Explain to me how that feeds back to a superior or perhaps satisfactory or acceptable liquidity picture for investors.
Yeah, so our fund offers monthly liquidity windows to investors. So every investor has the opportunity to put in a redemption request on that monthly basis. We will firstly pay that redemption out of available cash, which can be incoming investors coming through, or the cash that we naturally have sitting in the fund. The second way which we will look to get liquidity is by the loans or the underlying assets maturing. So the principal and interest will be repaid, and that goes back to investors.
So let's just talk about an extreme scenario where every investor wants to redeem at the same time. What happens?
We would look to firstly pay all of the available cash out of the fund. From that point, you go into a gating procedure.
Which is common to all funds, all managed funds.
All managed funds in Australia will have some kind of gating mechanism in there to ensure that investors aren't disadvantaged. So what we would look to do at that point in time, if 100% of investors would look to redeem their capital, we would gate the fund and we would stop all new lending in our warehouses. So any principal and interest repayments would come through. Everyone would be paid out, all investors would be paid out their pro rata proportion of that inflow of capital, and we would continue to do that. So just to give you some context on the runoff sort of profile for the fund, at the back end of July, the fund had 75% of its assets or of the underlying loans maturing within 3 months. So you can see that they do come back relatively rapidly.
Brett, another myth, these funds don't perform in poor economic conditions. I mean, it's probably the most common accusation that's levelled at these funds. They haven't been through a full economic cycle. It's worth pointing out there are some funds that are relatively new. Your wholesale fund is 7 years old, and you're an ex-banker. There are some of these funds that are much younger and aren't run by bankers. That's not the case for you. What's your experience in tougher economic times, and what's the experience of the fund?
The fund ran through the whole COVID experience. So obviously that was an extremely disruptive timeframe for every business in Australia and more broadly globally. We also had a technical recession at the back end of 2022. Granted, not a deep one, however, a technical one. Through that time frame, our fund performed well. So the lowest monthly distribution was 60 basis points. So note, we still maintained a $1
So even
NAV.
during that trough in economic conditions, and I remember it, out of COVID, we had something like 4 million people unemployed. The low point was a 60 basis point repayment that month.
That's correct.
Right.
That's correct. And if you're looking at, you mentioned I come from a banking background. We look at risk in a very bank-like way. So when we're looking at our underlying portfolios, we're using long timeframes of data to stress test our portfolios. So as an example, we're currently using over 50 years of bank and non-bank data in the stress testing of our portfolios. So whilst we haven't run through a deep and extended recession as a fund, we explore those downside scenarios with deep and long history data.
And I've been asked this question by several people. Presumably, we would see a recession coming. And if we saw a recession coming, number one, investors could redeem if they wanted to, if they were nervous, they could do that. And alternatively, you're managing who the money is re-lent to as it's being paid back. So as you're recycling that capital, presumably you've got a methodology for deciding whether to extend further credit. How do you go about assessing that?
Right now is a really interesting case study. So we're seeing lenders with a lot of applications coming through. However, the approval rates have gone down because the borrowers are not necessarily meeting our criteria. So, we filter at the front end, and that's a frustrating time for the lenders. They're inefficient in their approval rate right now. However, that's enabling us to retain a high quality book.
Thanks for that, Brett. Well, the next myth that we've got is that private lending or private credit is really about lending to distressed businesses. Talk about the quality of the businesses you're lending to.
We do not do distressed debt. So we do not lend to businesses who are looking to borrow their way out of trouble. So what we've seen post-GFC, there were some regulatory changes, the Basel III changes, which basically led to a lot of the big four banks focusing on either residential mortgages in their lending books or very large corporate loans. And what it did was it left a significant underfunded market for your SMEs through to your mid-market corporates. So a funding gap of circa $400 billion. And these are businesses that are screaming out for debt capital to help them increase their growth or profitability, but it's not being provided by the big four banks. And that's where private credit has become significantly larger, because private credit funds are stepping into that breach to provide that debt capital to quality Australian businesses.
So, Brett, another way to mitigate risk is through diversification. And one of the myths is that these funds aren't diversified enough. Now, I note that there are many funds that have a concentrated book of very large loans, but you're managing things quite differently. Talk about that.
Yeah, so our philosophy is very much predicated on diversification of risk. Now, we look at that from an industry perspective, a geographic perspective, and across a number of lenders as well. So to give some context, our portfolio has over 13,000 loans as at the end of July, and that will continue to expand with our funds under management. So a very well spread book, average loan size in around $105,000. Now, to look at the larger end of our exposures, our maximum concentration currently is running at about 3% of the book.
Right. So your biggest loan, if you like, or the biggest exposure is just 3% of the entire book. So that's a very different picture to many other funds.
Yes, it certainly is.
So there you have it. We've dispelled many of the myths associated with private credit. I'm sure you have plenty of questions. And if you do, please email us or give us a phone call. We'd be more than happy to discuss any of the Aura funds with you. We look forward to talking to you again. Have a great day. Thanks, Brett.
Thanks, Roger.